Hello, everybody. Good morning. I hope you're doing well during this period of difficulties for everybody. But life goes on. We have to carry on with our duties. And I hope that listening to OFI Asset Management, to Benjamin Louvet about precious metals, can help you navigate better during these difficult times and consider this type of investments as something valuable for the future. So that's all I have to say. Thank you very, very much for joining us. And I hope you will like what Benjamin has to say.
Okay, thank you, Juan. May I start, Nicolas?
Yes, so everybody who is connected with Zoom, we will see the presentation on the screen. And for the other people, Juan or Jacobo have sent you the presentation. And for the people on Zoom, they can see also the chat, and they can ask questions on the chat. So you can go, Benjamin.
Okay, great. So thank you for being here this morning. We will try to make a summary of what happened on the gold and precious metals markets in the past few days and weeks. Firstly, try to explain why the market went sharply down, which is quite counterintuitive. And then trying to see the kind of perspectives that we can have on these markets and why we're still confident that there is some performance to find in the precious metal sector. Next slide, please, Nicolas. So first, I will try to explain what happened in the past weeks and why the markets went sharply down. So first, we will talk a little bit about, more generally speaking, about precious metals, and we will focus on gold and silver to understand what happened. The first thing to say is that at the start of this sanitary crisis, we saw gold and silver prices went sharply down, and this was due to several factors. And mainly due to forced liquidation. Forced liquidation due to three main factors. First one, in the first day of the crisis, the 27th of February, for the first time, the CME, the market where gold contracts are traded, gold and silver contracts are traded, and even platinum and palladium contracts, decided to raise deposits for each contract. So you have to put more money in order to get one contract on your account. And that means that speculators that use leverage had to reduce their position. So that's the first reason why there was a forced liquidation. Second reason, which is quite odd, the forced liquidation was triggered by the move on oil prices. Indeed, a lot of investors through the world is exposed to commodities in general using commodities index fund. The main indices in that sectors are the GSCI, Goldman Sachs Commodities Index, and the BCOM, Bloomberg Commodities Index. And as the price of oil went sharply down, a lot of investors decided to reduce their exposure to commodities, and so they decided to sell their position in these commodities indices. But doing that, they sold their position on oil, but they also sold their position on other commodities, and especially on gold and silver. So the move on the downside from the oil prices took the gold price down because of this forced liquidation. Third reason is forced liquidation due to the down move on equities and bonds, because a lot of investors had big margin calls on this position, and they had to find some liquidity in order to cover this winning positions and satellites position in their portfolio. So they sold their position on gold and silver and other precious metals. So all these reasons explain why the market went sharply down. But today, the good news is first that we can see that gold prices are going back up. And today, gold price is almost only 5% down from its highs before the sanitary crisis. So it's quite a good news, and we'll see that there is still a big potential on this market. We have some other indicators that are quite good today. The first one is physical markets are highly tensed. First, when you look at the ETF markets, you will see that the holdings are at their highest ever. So this is quite a good news. And there is also a lot of things happening on the physical market with big premiums on bars and coins that led us to think that a lot of people are interested in investing in gold and silver today. So that's quite a good point also to note. So there is a lot of potential here, and if history is any guide also, you will see that there is a good reason to think that price of gold and silver will go sharply up in the coming weeks or months. Next slide, please, Nicolas. So as I mentioned, there was a big sell-off as CME raised deposit 3 times in the past months, and as the oil price went sharply down, and equities and bonds also forced some liquidation. The good news is, as you can see on this graph, which shows you the managed money position on the COMEX gold market, which is the biggest gold contracts in the world. You will see that the net position went sharply down, even if it's not quite clear here on my phone, but it went down to from 300,000 contract to 177,000. So it seems still high, and so you can think that there could still be some liquidation on that. But the good point is that, as you can see on this graph, for the past 5 years, the net position never went below 100,000 contracts. So it seems that there is not a lot of liquidation potential on that contract. When you look at other precious metals, for example, silver or platinum or palladium, all these contracts have net positions that are really, really low. On the palladium, the net position is at its lowest rate since 1 year. So, and close to zero. It's almost the same on silver and platinum. So there is no fuel to trigger a new liquidation move. I would say on these free markets. There is still some potential on gold, but we think that this potential is limited because, as I mentioned, the physical market gives us some indication that the market is highly tense today. Next slide, please, Nicolas. So as I mentioned, on the physical market, you can see here that the market is completely on fire. You have here the total known gold ETF holdings, and you can see that today it is at its highest ever. We never saw such a position on gold, and silver is also really high. You have a big demand also on silver. So this information is quite good, because that means that there is maybe really financial reason why gold futures went down, but the physical market gives you a completely different feeling. And so it's I think a good news. You can see on the next graph, Nicolas, please, screenshots of the United States mints who sell the coins and bars in the United States. And as you can see on this screenshot, which was made on the 26th of March, this is an American American gold eagle of 1 ounce, and it is at sale for $2,175. So that means that you have a big premium compared to gold price, because today an ounce of gold is quoted something like $1,600, and here you had to pay almost $2,200 in order to get a 1 ounce coin in the United States. So there is big premiums on coins. You can also note that in France, for the first time in history, the quotation for gold coins were stopped Friday the week before, because there was no more offer of this kind of coin. So there is no way to quote the market because there was no offer on this market. So it is harder and harder to find some gold today. Things are also really difficult on the physical market because there is another historical move in the past few days, which is that refineries had to close because of the coronavirus. Let me be clear, never in the history refineries in the world close, even in wartime. Okay, never the Swiss refineries, for example, close even in wartime. So that means that it's really, really special. And that means that there is no way to refine gold today because refineries are closed. So that means that it will be harder and harder to find some gold on the market. The other point is that today, even if you have still some inventories, for example, in Switzerland, it is difficult to move it because gold is moved around the world using planes, okay? And today, planes are grounded. So there is no way to move gold from one point to the other, and it is harder to get gold where it is needed. For example, last week in New York, the COMEX market decided to create quite quickly a new contract on gold on another type of bars, because today the contract is based on 100 ounces bars, but there is no more 100 ounces bars available in New York. So they decided to create a new contract based on a 400 ounce bars, because they still have some of these bars available, and they hope to find a relief for the market using this kind of bars. But today the contract is still not created, so there is still a high tension on this market. So you have a lot of tension on the physical market. You have also tension because today a lot of gold miners had to stop their activities. For example, in Canada, the Canadian government asks for non-essential business to close, and so a lot of gold miners had to stop their business, and that means that the gold production will go sharply down in the coming weeks. So there will be definitely an adjustment maybe on the demand. For example, today in China, there is less and less demand, but you will also have an adjustment on the production side. So I think that it will be a balance for the period. And so after the market should run quite normally when the market will reopen. Next slide, please, Nicolas. So now we will try to see what can happen after and why we are still positive on gold and silver. The main point is, as I mentioned here, is that real interest rates are the only thing you have to look at. Okay, As I may mention when we met in Spain in the past, you have to know that gold is interesting for a portfolio depending on the yield that you have on other assets. For example, if you invest in stocks, you have dividends. If you invest in bonds, you have a yield. When you invest in gold, you have nothing of that, okay? You only, you have a zero return, okay? So it is not really interesting for an investor, especially for institutional investors who make an asset and liabilities management and who have to invest in assets that give them a return that could cover their liabilities with their customers. So gold is of no interest in that case. But today, as there is more and more bonds with negative yields, having an asset that gives you a return of zero is better than having an asset that gives you a negative return. So gold is highly linked to the interest rates level, and more specifically to real interest rates level. That means nominal interest rates minus inflation. So in the past weeks, we saw a lot of movements on both nominal interest rates and inflation. First, as the global economy came to an halt, you saw inflation anticipation went sharply down. And so in the first time, you saw real interest rates going up. And that's maybe a reason why also gold and silver prices went sharply down. But at that time, the Federal Reserve decided to boost the market, to help the market, moving the nominal interest rates down. So they made two surprise moves. First, 50 bips rate cuts, and secondly, 100 basis point rate cuts, and move the nominal interest rates in the United States down to zero. And at that time, the real interest rates went again down, and the price of gold starts to move up again, which was quite a good news. So what can happen in the future? If you consider all the package that was decided all around the world, that means that all this package should have an inflationary impact in the coming weeks or months once the sanitary crisis is over. The second point is that considering all the debt that it generated, that means that it will be harder and harder for governments to move the nominal rates, interest rates up again. Let me be clear. For example, as I mentioned when I met you, maybe in Spain, when you are a government like France, where you had before the crisis a 100% debt to GDP ratio, that means that if nominal interest rates are going up 1%, that will mean that you will have to pay in complementary interest on your debt 1% of your GDP. Not straightforward, but because there is a duration on the debt, but this is where you go. So considering that debt to GDP ratio will go sharply up everywhere in the world, for example, in the United States, they decided a 10% GDP sanitary relief package. That means that it will be harder and harder to raise interest rates because it will be unbearable in terms of interest you have to pay on your debt. So for us, after the crisis, you will see nominal interest rates staying low for long, maybe forever. And at the same time, as there is a big in terms of money, in terms of fiscal stimulus in order to help the economy, you will see inflation coming back. And so real interest rates will go down, and so gold and silver prices should go up. Before the crisis, we made some forecasts at the start of this year, saying that according to us, you will see the interest rates in the United States going down to zero. You will have a Japanification of interest rates in the United States because it was still a place where you can find some return, 2%, with a quite limited risk. And so we thought that there will be some inflows on this debt. Today, the sanitary crisis accelerated this move, and nominal interest rates in the United States are already at zero. But at the same time, if you consider that inflation will come back to just to the level where it was before the crisis, which we can doubt about, it could maybe be higher because of all the fiscal stimulus I mentioned before. You will see, due to the negative correlation you have between gold and real interest rates, you will see gold prices going up to $2,000 an ounce, which was our target before the crisis. And we still think that it is a minimum target now that the sanitary crisis is here, because rates went down and inflation will at least come back to the level where it was before the crisis. In that circumstances, gold prices should go up to $2,000 an ounce or even above this level. For silver, the same logic leads to a forecast of between $21 and $22 an ounce. Considering that today silver prices are at $14 an ounce, that means that you have a high potential, a bigger potential on silver than on gold. That's the point for gold. Maybe, Nicolas, we can go to the next slide. Yeah, one more thing. You can see here a graph that shows you what happened in the past when the Federal Reserve decided to make a surprise cut. In the history, each time the Federal Reserve decided a surprise rate cut, in the next 18 months, you see the price of gold going up plus 26.1% on average. So that's quite a coincidence, but if you make 26% up from the low we saw when the Fed started to make its rate cuts, it leads you to something between $1,900 and $2,000 an ounces, which is our target. So everything is quite logical, and everything leads us to think that price of gold can go up to $2,000 an ounce, and silver prices can go up to $21 to $22 an ounce. Next slide, Nicolas, please. Okay, now we will try to talk a little bit more about the two other metals that we have in the portfolio, platinum and palladium. First, I will talk about platinum. Platinum went sharply down. I would say that first it's due to strong liquidations, and platinum was maybe hardly hit because it is highly linked to industry, and especially car manufacturers, to the car industry, because platinum is mainly used to make some catalytic converter for diesel engines. So as we saw, the car sales in China went down 80%. In France, it was down 85%. I think in Italy, it was down 72 or 75%. So it completely came to a halt. So it's quite logical to see that the platinum prices went sharply down. But perspective on this metal is quite good, because as I mentioned, platinum is used for catalytic converter for diesel engine, and today climate change is a big topic. We have to address this problem, and for that, you especially have to reduce cars emissions. So that means that environmental rules for the car sector are harder and harder. And what does that mean? If environmental rules are harder, you have to embark more platinum in your catalytic converter in order to treat the fumes of your engine. So, for example, this year, China implemented a new regulation called China 6, which is quite equivalent to the Euro 6B regulation that we have in Europe. And that means that Chinese car manufacturers will have to embark more platinum in their catalytic converter. Next year, it will be India, which will implement the Barrett 6 emissions rule, which is almost the same as China 6 or Euro 6b. And next year, you will also have in Europe a new regulation called Euro 6d. And Euro 6d is based on real condition emissions for European vehicles. So that means that, again, European car manufacturers will have to embark more platinum in their catalytic converter in order to treat the fumes of their cars. So all these things are quite a good support for platinum price once the economy is back on track. Okay. You also have to notice that production is under constraints today because first, producer, because of the down move of the platinum prices in the past years, producers decided to restrain their production. So, for example, one of the biggest producers in South Africa, almost 80% of the platinum produced in the world is produced in South Africa. One of the biggest producers in Palladium decided in the past, in 2018, that in the 2 coming years, it will reduce its activity, closing 5 of its 11 shafts, and it will lay off 13,000 of its 40,000 employees. So they decided to reduce the production and to sell less, but at a better price. You also have some specific situation. The biggest platinum producer in the world, Anglo-American Platinum, just announced before the sanitary crisis that on the 10th of February of this year, he had an explosion of one of its sites, and it has to close this site, and it will reduce its production by 500,000 ounces this year, and 500,000 ounces means 6% of worldwide production. So the worldwide production of platinum will be reduced by 6% this year. Before that, Johnson Matthey, the biggest catalytic converter producer in the world, forecasted that the platinum market should be almost balanced before financial demand. So we can consider that after this incident and this force majeure declaration by Anglo-American Platinum, the platinum market, when economy is back on track again, will be in light deficit this year. So this is quite good for platinum prices. So we are quite positive on this metal, even if platinum is the least favored market of the portfolio. Why? Because as I mentioned, platinum is used for diesel catalytic converter, and the diesel market is not really dynamic, even if it's better in the past years, because you have to know that if the private sector diesel car sales are still on the downside, the down rate is slowing today. So we are still down, but at a slower pace. And at the same time, the professional diesel car sales are going up, and up. And so the diesel market should go up this year by 1%. So it's quite positive, and it should give a boost to platinum. Also considering that new environmental rules will also help the consumption of platinum. So we, as the platinum prices went sharply down, we think that there will be a recovery, but we have to wait until the economy is back on track to see the platinum prices go sharply up. But the potential of recovery is around 50% in terms of performance from where we are today. Today, the price of platinum is around, I would say, $800 an ounce. Let me just check. I will look at my computer just to check that. Yeah, they are at $730 an ounce, and we do think that we can go up to $1,100 an ounce. So there is more than 50% in terms of performance forecast, but we have to wait until the economy is back on track. Finally, next slide, Nicolas, please. We will talk a little bit about palladium. And palladium is a completely different story. First, palladium is mainly used to make catalytic converter, but this time for gasoline engine. So it was sharply on the upside due to the fact that there was a Dieselgate in 2015, and so the demand for gasoline vehicles went sharply up. And the consequence of it is that demand for palladium was on the upside for years. And just to let you know, palladium performance on the past 10 years is plus 1,000%. Palladium performance on the past 5 years is plus 500%. Palladium performance on the past year in 2019 was plus 60%. And before the sanitary crisis, palladium performance for year to date was plus 40% already. So it's completely crazy because this market is on deficit, and this year it will be on deficit for the 9th year in a row. So you really have a problem on this market. And the thing is that when you talk about precious metals or metals in general, I would say there is no worry when you have a deficit, because usually you can find an inventory. The only thing you have to do is to move the price up, and you will find some people who have an inventory that will bring it back to the market. But when you are in your 9th year in a row of deficit, finding an inventory is harder and harder. And today, that's the problem that we have. The consequence of it is that as it is more and more difficult to find some palladium, the market try to incentivize people to put more palladium on the market right now, and try to incentivize people to delay their purchasing of palladium. So for that to happen, the forward structure curve on the palladium is completely reversed. So we are now in what we call a backwardation situation. So that means that the price of palladium today are above the price of palladium tomorrow. By doing this, the market gives an incentive to producers to sell their palladium right now, because if they sell it right now, they will sell it at a higher price. But also by doing this, they incentivize buyer of palladium to delay their purchase to a later period, because if they wait, they will buy the palladium at a lower price. When you have this kind of forward, if you are an investor or speculator and that you buy palladium, each time you roll your contract on the next one, you will buy the new contract at a lower price compared to the price of the contract that you already have. So that means that you will have a yield, what we call a convenience yield, that will give you a return above the palladium performance. And last year, for example, this return was between 3 and 4%. Right now, the palladium forward curve gives you a return around 4% yearly. So I think that it is really important, because that means that for palladium, we will not have to wait until the economy is back on track to see the price of palladium going up again, because you will see more and more speculators coming in this market in order to get these convenience yields, and we already see it. To let you know, the palladium market hit its lowest price for this year, the 18th of March, and since then it went up 60%. Okay, so it already rebounded quite sharply, but there is still a big potential. Why? Because palladium, as I mentioned, is in deficit and is highly needed today. Why? Because as for platinum, palladium is used for a catalytic converter, but for gasoline engine this time. And the environmental rules also impacts this industry. To let you know, I mentioned before that China implemented China 6 regulation this year. The consequence for a palladium market is that this year, Chinese car manufacturers will have to embark 25% more palladium this year than the year before in order to comply with the new regulation. Okay, this will be the same in India next year. in Europe, the Euro 6 deregulation that will be implemented next year, will mean that European car manufacturers will have to embark 10% at least more palladium in their catalytic converter next year in order to comply with the new regulation. So the picture is really good. That means that when the economy will be back on track, there will be a big boost for palladium, but we don't need to see the economy back on track in order to see palladium prices going up, because you have this convenience yield that will attract a lot of speculators in this market in order to get the return that the palladium market gives you today. And knowing that it gives you this return, being on a market with really good supply and demand factors that could help the market to go up. Good fundamentals today on the palladium. So we are quite globally positive on the fund, because we see a big potential on gold, as I mentioned, $2,000 an ounce, a big potential in silver, around $21 to $22 an ounce, knowing that we are at 14 today. So more than 50% in terms of performance. And this performance can go, can come in the coming weeks or months. We are not alone to say that, because, for example, Citi and Deutsche Bank say that gold could go up to $2,000 an ounce. And Goldman Sachs said a few weeks ago that gold should go up to $1,800 an ounce in 6 months. They changed their mind, and now they say that gold will go up to $1,800 an ounce, but it will be in a 12-month period. But they are still on the upside. Platinum is the poor guy of the portfolio. It will go up, but it will take time. It will need to see the economy coming back on track. And finally, palladium should go up sharply. It already began, in fact, and it can go up to $3,000 an ounce, or even above that, knowing that today we are at $2,200 an ounce. So there is here 30 to 40% potential in terms of performance. That's what I wanted to say about the market in the portfolio. Next slide, maybe, Nicolas. I think that it's over, but I just want to check. Yeah, that's over. So I finished with my presentation. If you have any question, I will be happy to answer it if I can.
Benjamin, I'm Juan Marin.
Yeah, Juan.
Yeah, just if you can give us a short answer to a question. The fund never moves the positions that are fixed in the index, because it has to comply with UCITS regulations, isn't it?
Yeah, yeah, right.
Therefore, you cannot allocate more weight to a metal than to other to take an advantage of the price movements.
Yeah, you're right, Juan. I have to say that I would be happy maybe at some times to raise the allocation, for example, on the palladium, because we were quite positive on this metal for a long time. But to be UCITS compliant, you have to be diversified. You have to have at least five assets in your portfolio. Each of them can't be more than 20% of your allocation, except one that could go up to 35% if you justify it. So we decided to put this 35% on gold, because it is the main active and the most well-known precious metals. And so on the other one, we can not invest more than 20%. So we are at the limit. What we could do is to reduce one of these metals if we think that it has no potential. But today, as I mentioned, we think that all the metals in the portfolio have a good potential in terms of performance. So we don't want to reduce the allocation on one of it.
Okay, thank you very much.
Okay, so if you have any other question, don't hesitate to ask Juan for, and we will try to answer it as soon as possible. So thank you very much for joining us. and take time to hear my story, and I hope it would be useful for you, and that it will give you a clearer picture of these markets, which were quite difficult in the past few days and weeks.